Global investment markets have never been as diverse and accessible as they are today. Many investors understand that it's important to have enough assets invested offshore, yet it's the detail that really trips us up. But when we get the detail right, it makes all the difference. I'm your host, Jennifer Aronsa, and I'll be talking to industry specialists to get their views and practical tips about how you should navigate the global investing world. First up today, we've got Kenny Rapson, CEO of Discovery Invest and Employee Benefits. Kenny has 32 years experience in the financial services industry. Welcome, Kenny.
Thanks, Jen.
And I think I want to jump right into our first question today, being that, and based on personal experience from friends and family, we tend to make financial decisions based on what our friends and family tell us. So it ultimately ends up, we make investment decisions based on other people's investment experiences. So it's word of mouth. What do you think are the pros and cons of that? Is that wise?
Thanks, Jen. Look, I think the world has become so complicated that it's difficult now to rely on word of mouth of anybody, to be honest. And I think really that's the need for proper financial advice. You know, if you just think about global investing, you're looking at complexities of different jurisdictions around the world. You're looking at complexity of tax planning, estate planning, and it's become very complicated. The regulations are changing regularly. And therefore, I think you can pick up some good tips, maybe from your family.
At a bribe.
The reality is, I'm not sure over the long term you'll get the desired outcome that you're looking for, and probably some nasty surprises along the way in terms of how it manifests with tax and a payout on a death or something like that. So I think financial advice is absolutely crucial. And I think finding the right financial advisor that you trust in the space, who has the offshore knowledge, making sure they understand your family dynamics, the needs of your family. Why are you making this investment? Are you making it, for long-term investing purposes? Are you doing it because you're planning on living in another jurisdiction one day? Are you doing it because you're planning on your kids living in another jurisdiction one day? Do you need liquidity, etc.? So it's so complicated. And therefore, whilst I think you can pick up the odd good tip from someone by word of mouth, the reality is you need to run that by someone who's competent in terms of the law, in terms of tax, and proper financial planning to see how it manifests.
And as we know, with offshore investing, it's often the detail that makes all the difference in your investment outcome, because you need to get the detail right.
Absolutely. And you see things, small things that are changing all the time. For example, I wonder how many of the listeners are aware of something called situs tax. I'll spell it, S-I-T-U-S. How many of them actually have even heard of it?
Yeah.
Well, it actually means, for example, that if you're holding shares directly in the United States, on death, you're going to have huge taxes. So it might look like small detail, but the percentages are enormous. And the surprises down the line could be fairly big if you don't think about those things up front now and plan accordingly for them. So yes, it is having an advisor who understands the detail, importantly, who can explain it to you in layman's terms, that you're comfortable with the decisions that you're making.
And ultimately guide you through this complex yet rewarding world of global investing, because we do want to have exposure to markets. Is how we go about doing it.
Absolutely. The opportunities of investing offshore are enormous. And we can talk about that in a bit more detail just now. But certainly one wants to make sure that you avail yourself of those opportunities and do it in the optimal way.
Great. Now, Kenny, last time I checked, locally in South Africa, there are over 1,500 unit trust funds. Globally, you're looking at over 40,000 funds. So an investor who wants to make a decision between which asset manager, which funds, it's a plethora of choice, and oftentimes that's not an easy decision to make. So what criteria, what tips can we give investors if they do feel they are comfortable taking this journey on by themselves, which we advise against? It's best done with a financial advisor. Broad, high-level ideas for how do you choose?
As you've said, it's a very complicated market out there with lots of options. You're just talking about 40,000 odd mutual funds. But of course, there's direct share investing, there's property investing, there's crypto investing, which is becoming a little bit more topical. Do you invest passively, actively, etc.? It's becoming a lot more complicated.
Sounds like we're getting to 100,000 now.
Correct. Even locally, in fact, many of those opportunities exist. So I think you really need to look for packaged solutions where that work is being done for you. I think for the average South African to try and navigate that world, it's incredibly complicated and difficult. And I think you have to rely on the relationships that companies have with top brands around the world who are doing this work for you. And, you know, they have all the internal expertise, a lot of professionals who are doing this day in and day out, analyzing the top funds, where you should be, packaging solutions. So I think for South Africans trying to invest offshore on their own, I think it's a tough task and probably, again, not going to get the outcome that you're looking for. And I think that is really the reason why many companies have come up with great packaged solutions, because they realize it's just too difficult for not only individuals who want to invest, but even for financial advisors to be able to analyze thousands of funds around the world, different jurisdictions, different currencies, different legislation around the world, different themes around the world. It's just too complex. So having professionals do this for you, I think makes it a lot easier. And that's certainly the solution that we've chosen in Discovery Invest, which we can talk about in a little bit more detail. But certainly partnering with the best out there takes away that kind of feeling of helplessness from you as the investor. It sort of makes it a lot easier, I think, to navigate the environment and to rely on those companies that have the expertise to do it.
As Discovery Invest, we invest on behalf of our clients as well. So when we choose who to partner with, the best in the world, we have partnered so far with the world's biggest asset manager, BlackRock. We have other strategic partners as well. How did we choose? And I think oftentimes investors want to make these decisions themselves. So I would imagine that we look at things like company size, and there are a number of things. What did you look at first when you made that decision?
There's a checklist that one looks at in terms of evaluating asset managers, and if I can call them fund blenders or solution providers. Firstly, the track record of any company, I think, often speaks for itself. It shows the level of expertise inside a company. It shows very often the level of the bench strength. You know, we know that employees in asset managers sometimes leave and move to another company. The question is, can that asset manager still continue producing great results thereafter? In other words, how strong is the bench strength, the rest of the people in the business, that if someone is not there, others can step up and continue the job.
What's their contingency?
Absolutely, and we see that in companies that we deal with locally, 91 Offshore, BlackRock, Goldman Sachs. These companies are huge, they have huge bench strength, they have huge capability. And therefore, analyzing that, I think, is very important for us. Size is also typically an indicator of that, because if they have all the breadth of skills that we require, they typically will be a bigger outfit, being able to sort of work in equities and bonds and alternative investments and property in different jurisdictions, etc. And often you see that the way to do that, they themselves need multiple offices around the world. They typically have setups in many jurisdictions, sometimes 30, 40 different countries around the world. They've got offices analyzing that particular region to provide the output. So I think really, whilst the size of the company does matter, the track record is crucial. The size, by the way, typically indicates that the market likes them, that a lot of money has gone there because they've demonstrated all the right skills. I think regional presence is crucial. You know, how much expertise around the world do they have? Very often you'll find South African fund managers are actually picking shares offshore. And you just wonder, really, is that in line with what you would get from an offshore fund manager doing the same?
How good can your contextual framework be?
Exactly. You're doing it remotely. You're not interviewing companies that easily, even though they go on road shows and all of that. I think it's more difficult. So, you know, working with fund managers that I think have that presence around the world makes it a lot easier. And as I said, you know, we look for companies that have not only the brand that reflects their success in the past and their track record, but the deep skill sets to really provide the outcomes that we're looking for. And that's really why we've partnered with companies like BlackRock and Goldman Sachs. You know, these names are legendary. They've been around for decades. They've really stood the test of time, and crucial in terms of making sure that we have comfort in the solutions we're providing our clients, that we're kind of resting on the shoulders of the biggest and the best out there to do this work for us.
We look for depth and breadth of skills and resources in all of our partners. And where we get that ticked, that's where we explore a bit further into track record, reputation, and etc.
Absolutely.
What do you think? How would investors typically evaluate a fund manager's reputation? Are there independent surveys, benchmarks that they could use to just help them a little bit?
I think there are various benchmarks available. You'll see various surveys that are done, results from whether it's Morningstar or Plex, Crown, etc. The truth is, many of the algorithms behind those particular surveys are not that clear to a retail investor themselves. And therefore, I think very often you might not draw the right conclusion from what you see in various surveys. For myself, I think of which fund managers have shown consistent good performance over the long term. In other words, I'm not so interested in a fund manager that has great performance over the last 3 months or 6 months. Who has shown great performance over 3 years, 5 years, 10 years, 15 years?
And just to clarify that for listeners, what do you regard as long term? Do you regard that 5 years plus, especially in the offshore investing environment?
Depending on what your portfolio actually is, if it's equities that you're invested in, then I think long term is 5 years plus. That's not to say that themes don't change rapidly. You can find that themes in various economies change rapidly, and fund managers have to constantly change what their views are, their macroeconomic views, their microeconomic views, which companies they prefer, etc. But I think one needs to look at the long term and make sure over the long term you're getting a great result. And short-term investing, one needs to try and understand what really drove that great result over a short period of time. Is it meaningful over the long term?
Is it cyclical, perhaps?
Absolutely. Or is it even just a fluke? Some fund manager got something right, a particular call right over the short term. And I think that's a dangerous way of investing. And therefore, I think long-term track record is sort of what impresses most financial advisors, most clients. Certainly myself, I would be looking for that longer term, 5 to 15 years, great performance.
And consistent.
And consistent. Look, you will find, and it's important to say this to all of our viewers, it's important to say that every fund manager will have a period where a fund may not be performing the way it did last year, and they all have it. They all have a dip at some point. The truth is, when you look at it over the long term, those short periods of underperformance tend to wash out. If, of course, they're having consistently bad performance, well, then you need to make changes in terms of what you're doing. And those are the things we look at all the time, and we are continually challenging our fund managers and partners that we work with. Is this doing the right job? Why is it underperforming, even if it's only short term, over 3 months? What caused it? And are we comfortable with that? So it isn't a process of interrogating to continually make sure that one has the best for the clients that we're servicing.
Now, I suppose that leads to some tough conversations at times between you and the portfolio managers.
I think if you've got great relationships with your fund managers, and you feel it's an open and honest relationship, then you can ask those tough questions and expect proper answers around them and not marketing spin in terms of what has driven the outcome. Very important.
Looking for fundamentals.
Absolutely.
Right.
Absolutely.
I want to touch on a particular investment criteria I think that forms part of any investor's decision-making process, and that is fees. Although very important, I suppose we need to look at it from a broader framework, and that is, do we get value for money? It's one thing to pay fees and look at it, the absolute number, but you've got to ask yourself, am I getting value for money? Can you give investors and listeners some tips in terms of how do I determine I get value for money and I don't just look at the number?
It's a great question, and I guess spoken about around the world. My answer might be somewhat controversial, to be honest. I actually don't look at the fee levels at all. I look at what is the net performance after fees. In other words, we've seen it in the past. Sometimes a fund manager is performing badly, and money's flowing out the front door, so they drop their fees. So now they look very competitive. They look, cheap, and suddenly the market's quite excited around the fee drop. But of course, they haven't gone to say, well, why did that happen? Why did they drop the fees? It's actually because they are chasing money urgently, because money's been flowing out the front door. So I think you have to be very skeptical when you just suddenly see fee drops. What is behind it and why is it happening? I'm kind of focused on net performance. To me, that's the biggest issue. So, if you look at some types of investments which maybe more high net worth clients invest in, things like hedge funds and things like private credit and private equity, very often those funds are high. You could be paying 2% up front, 20% each year of the return. But it doesn't matter if those returns are great and better than anything else you could have put your money in. And I know even for myself, it took some time to get used to that concept. When I started investing in private equity and started seeing these numbers, and you think it's crazy, I'm not prepared to pay that. But actually, when you get a great return every year after that fee, you say, well, I actually am prepared to pay that if I get a great net return. So my view is it's very hard for a client to assess in investments value for money. They don't really know typically what is happening in an asset management shop, what work is required, what is the cost of that, how complicated actually is it, and of course what risk is that asset manager taking on themselves in terms of the fee that they're demanding. But I think clients can be happy that if after fees they're getting a great return or getting performance that they're very comfortable with. To me, that is really what should drive the debate. And as I say, you can compare funds in any sector across the industry, and you'll see some, quite a diverse range of fees. And you might think that, in fact, the lowest fee was the best investor. And in most cases, and we've done a lot of that work in Discovery, in most cases, that's often been associated with bad performance. So I think it's important to correlate the two, fees and performance, and make sure that the result you're getting at the end is appropriate.
What I'm hearing you advocating for is a more broader decision-making process from investors, in that don't just focus on one aspect of the investing process. You mentioned things like check track record, check company size. Do they have the depth and breadth of resources and skills that you need to actually deliver that performance? You've mentioned a few other things, packaging and all of that makes it easier for investors to make those decisions. And not discarding fees, it's important, but look at the full spectrum of it.
Absolutely. It's a holistic decision. And, very often you'll see people just looking at it might be a fun fact sheet, or it might be a quotation or something, and they'll say, look at a fee and say, no, we're not paying that fee. But of course, that is clearly because they haven't been through that holistic process of understanding, well, what am I getting? If a fee is higher or lower, why is it higher or lower? What actually am I paying for? And I think once that's understood in a lot more detail, then you can really assess the overall proposition and say, is this the right thing for me?
Yes.
Absolutely.
Sounds great. And then I think right up front you mentioned the word packaging quite a bit, which is something I'm quite familiar with in the marketing world. But explain to investors, what do you mean by that from an investment decision-making process? How does packaging make it easier for the investor?
Right.
And why should they be interested?
It's a very important question, that. And really the way I think about it is in sort of two components. We've spoken now about the fund management itself, and there we've outsourced that to partners around the world that we're very comfortable with. But of course, there's a role that we have to play as well, setting up the actual underlying structure that supports those funds. Now, what do I mean by that? Well, firstly, what vehicle does the client invest in? Is it an endowment wrapper, which is really just a legal framework that has particular tax treatment, etc.? Is it a share portfolio? Should people be investing in retirement wrappers, etc.? All of that is really the service that we have to, as an R&D house, we need to make sure we're providing best of breed solutions for the clients that maximizes their tax position or optimizes their tax position. Secondly, liquidity. is absolutely crucial. Even with the best intention in the world, you might think, listen, I'm going to lock up an investment. I'm happy to do that for 10 years, and I'll continue paying, maybe it's monthly, whatever, for a 10-year period. The reality is we see your situation in life often changes.
Yeah.
Something happens that means you have to change tack in terms of your investment strategy. And therefore, liquidity is important. Are you able to access this money if you need to, or a part of it? And that's important. What we've done is we've optimized the structure through endowments, set up in Guernsey, which really optimizes that from a tax point of view for our clients. We split up every investment into 100 micro policies behind the scenes, which the client can't see. Now, typically in an endowment policy, you're allowed access only once in 5 years. But by having 100 multiple little policies behind the scenes, you've actually got 100 opportunities to access your money. So it's those small things which make a very, very big difference to how the investment will pan out for the client down the line. So packaging is really important. And then, of course, the ability to service it, to offer multi-currency solutions, etc., which is very complicated, very often frustrates clients because service in the offshore space is a lot more complicated than in the local space. Just even getting your money offshore, as any investor would know, it's a lot more complicated. There's a lot more red tape from any bank you're trading with in terms of what info they want, the source of money, proof, pay slips, all sorts of things which frustrates our clients and often makes them fairly angry. But the reality is once you get through that process and get the money offshore, the rest is taken care for you. The packaging is there, the product is in place, you don't have to do anything, you get your regular reporting. The fund managers are packaging the actual solutions by looking at, in the case of our BlackRock solutions, it's using external fund managers as well as their own solutions, a mixture of active, passive, geographical allocation. That's all being done for the client. So I think in terms of getting right all of that, the client wants a fairly seamless solution with the best in the world. And I think, of course, service is always tricky. It always kind of gets us in a little bit of trouble because it is complicated and it takes time to get everything done for the client. But nonetheless, I think the advantages of investing offshore far outweigh that little bit of hassle that you'll go through, the complexity that you'll go through up front in getting the investment done. So certainly something just to kind of grit your teeth through it, get it done, and then I do think you really do show your money the rest of the world, which has been one of our payoff lines. It's important to really make sure that you're looking at opportunities that you just can't get in the South African stock market.
And perhaps just reiterate, like you said, right up front to investors and to listeners, this journey is best tackled with the financial advisors. It's a complex, but it's a very rewarding journey. And if you partner with the right people, package it appropriately with a skilled financial advisor, you remove the complexity out of your investment journey.
Absolutely. Absolutely. And of course, as we've said already, that is the reason of putting that all together. Have the right advisor, make sure that they're working with a company that has the best of breed partners, that you actually have a sense of comfort. My money is being run for me by the best in the world. I think for me, that was part of the criteria we looked at in choosing our partners. Are we comfortable we would invest in that ourselves? And do we feel we would get that sense of comfort that our money is being looked after by the best? And certainly I think our clients will find that very rewarding over the long term.
And then maybe just lastly, and I know how you approach investments personally, and how when we launch anything, you believe that you will not launch anything that you would not invest in yourself. Our offshore offering, is this something you invest in yourself?
Absolutely. I believe very strongly in that. You can't put a product together and try to sell it to someone else if you're not prepared to buy it. It shows a flaw in the product. It's almost you're trying to flog something that you don't want to buy. So yes, I am an investor in our global endowment. Very proudly with BlackRock and Goldman Sachs. I've chosen both, and they've both performed incredibly well for me over the last year. And even our latest solution, our global credit solution that we've launched, I'm a strong believer in that product. The return, 7% net in euros, is a great return. And yes, I've put my money in that as well.
What about global mega trends? Some money in there as well.
And money in global mega trends. In fact, in a previous interview I did with one of the journalists that had been set up, in fact, I'd shown them I'd switched all my kids' money into global mega trends because I believe that is the future. It's not like a flash.
So even generational wealth.
So absolutely. I truly believe that the solutions we are providing are best of breed. They do require some understanding from our advisors and our clients, but hopefully they're rewarding over the long term to our investors.
Thank you, Kenny. That was very insightful. And thank you for sharing with us why who you invest with really matters. In our next episode, we'll be discussing the risk paradox. In the meantime, head over to our offshore info hub on www.discovery.co.za. Here you'll find reader-friendly resources that helps you make the most of the global opportunity out there. See you for episode 2.